Mr. Adam Patti, you're the CEO and the founder of Indexiq. Thank you for joining us at our studios today. How are you?
Great to be here. Thank you very much.
So can you tell us about Indexiq? What does it do?
So Indexiq is an asset manager. We primarily focus on ETFs, and what we do is we package institutional class investment strategies and we put them in an ETF so that retail investors can gain access to these more sophisticated strategies to help with their portfolio diversification and offer them opportunities to gain access to new exposures. So our products come in different categories of absolute return type strategies, which are our more hedge fund replication type products made for diversification and reducing your downside risk of your portfolio. We have commodity strategies, broad ones, as well as more niche for trading. And then we also have more unique international exposures around emerging markets and in other nations.
So how long have you been in this field, and how big are you?
Well, we're a small company. We're around 850 million in assets right now, growing very quickly. We grew almost 40% last year, so we're really encouraged by our growth. We started the company in 2006, and we launched our first product in 2009. Right during all the turmoil. So not great timing in terms of market opportunity, but great timing in that our products have performed exactly how we expected.
But as I understand, because you've been in the business for so long, you must be doing well. And what is the feedback that you're getting from your clients, from the contacts that you have? You've been in the market, you know the ins and outs of the trading. Where are the investment opportunities now?
Well, I mean, investors are fearful. There's no doubt about that. They're fearful because the market has had a 30% run-up over the last 6 months. And this recovery, or quote recovery, that we're supposed to be having in the United States isn't that strong fundamentally. So they are fearful. However, we are seeing investors starting to get back in the markets. And what I always say is that as long as you have a well-diversified asset allocation plan, you shouldn't worry about whether the markets are necessarily going up or down in any given day, because you got to stick to your plan, and your plan has got to include hedged type strategies to control your downside risk. And if you have that, and if you stick to your plan, you're going to have a healthy portfolio.
So you talk about allocation. Where do you see the growth? Equity markets, bonds, commodities, treasuries? Where should we invest in?
Well, broadly speaking, I think the equity markets, even though given the run-up, I think are still well priced when compared to bonds. Bonds have had a historic run-up over the last year, 18 months, 2 years. So as an individual investor, you need some type of fixed income securities in your asset allocation, but equities, I think, are providing more of an opportunity. And within that, I think there are certain segments of the equity markets that are more attractive. I like agribusiness. I think agribusiness stocks, the fundamentals of the food industry are pretty dire, actually, pretty scary if you actually look at what's going on in the marketplace. So I think the best way to play that is our small cap ETF, which is the ticker symbol CROP, C-R-O-P, gives you access to those small cap companies that most people aren't really gaining access to. So that's a great way to look. Another thing you should look at is Canada. Canada is a country that most people don't have exposure to. If you're buying an EFA product, which is your broad international product, it doesn't even include Canada. Excuse me. So you really want to have access to Canada. Canada is very strong in energy. It's also a nice indirect or more direct play on the United States growth, but not quite exactly direct. So it gives a little bit of a buffer to the United States. The best way to get access to Canada, we believe, is through our small cap ETF, CNDA.
What about the rest of the world? How about the emerging markets? Among all the countries, where do you see the growth in the emerging markets?
Well, emerging markets are a very interesting place right now. I think, look, the growth rates in emerging markets are far superior to anywhere else in the world right now. Their debt ratios are far lower. So you really want to invest where the debt isn't, and that is emerging markets. The problem with emerging markets is that the way everyone typically invests in them is buying large cap stocks. Now, these large cap stocks 20 years ago were much smaller. They gave you that diversification benefit that investors were looking for. Now, not so much. If you look at where these large cap companies are getting their revenue from, it's mostly from the United States and developed Europe. So in our opinion, what you want to be looking at is mid caps. Mid caps is really the sweet spot in the emerging market space. It avoids those small cap stocks that might have potential accounting issues and there's a little more volatility in them. It avoids the mega cap multinationals that aren't really giving you exposure to the emerging market nations. The best way to gain access to that, in our opinion, is EMER, which is the only mid-cap emerging markets ETF in the marketplace.
And you mentioned the developed European market. We've been going up and down with the European sovereign debt crisis and the slowing down. Where do you see this problem heading, or is it going to be ever resolved?
Well, I think it's going to be resolved. I think it's going to be long, drawn out, and painful, just like with Greece, right? And Greece still isn't even resolved. But, look how long that took. That took 18 months or so just to get to some type of resolution, which is not even completely resolved. So I think we're headed down the same path with Spain, with Italy. It's just going to be an ongoing saga. But at the end of the day, it will be solved. And I think what's happening now is that traders are trading on whatever the news of the day is, which really, all that news should really be baked into the market at this point. But they're trading on that news, and that's what's really pushing the volatility around in the equity markets.
But how about the U.S. companies and who has exposure to the European markets, like McDonald's, 3M, their sales, their profits were hammered by all this slowing down in Europe. Where do you see the first quarter results? Are we going to see a big about the analyst expectations figures, or are we going to see a less of a figure here?
Well, I think generally we're going to see very positive numbers coming out of corporate America in the United States. And the reason for that, or one of the reasons, is the warm winter. It was unseasonably warm, and that does add a boost. Well, it will hurt apparel retailers, perhaps, but manufacturers and exporters and other types of companies are going to benefit from that. So that might be a little bit of a false positive on the positive earnings results. But I think generally corporate America is doing very well. Yes. It's been very tight. They've cut costs, and their profits have been rising. So I think we're going to see some good numbers.
Last question. How about the QE3 possibility? Everybody's talking about this and its impact on the equity market, because it's been going up with the possibility when Bernanke says something, and it's going down when Bernanke doesn't say something, or others close the subject. Do you see a liquidity coming into the market more? And
Absolutely.
in what form?
Well, absolutely. I think QE3, I think the quantitative easing or the easy money policies continue for quite some time for a couple of reasons. First, unemployment is still high. If that ends, if the easy money ends, unemployment's going to go up. That's going to cause a lot of pain in the United States. And during an election year, that's not going to be acceptable. So I think that's one thing. But I think generally, easy money is good for risk assets as well. So I think if while risk assets have had a pullback over the last week, based on Bernanke's comments a week or two ago, I think we're going to see Bernanke start that quantitative easing again, or continue it for the foreseeable future.
So you do expect one. And this wraps our session. Thank you so much for joining us at our studios. We like to have you over again. It was a pleasure to talk to you about the markets and the investment opportunities.
Thank you very
Mr.
much.
Adam Patti. Evet, Levent'cim, burada röportajımız sona eriyor. Söz tekrar sizde İstanbul'da.